All right, welcome back to another episode of Network and Chill. I am your co-host Red, joined by my co-host Rick. What's going on, brother?
Hey, what up, bro?
Man, good. In the heart of summer, the weather is breaking, and it's just been a lot of good energy here, and excited for just more of these and more conversations. And today we have a great guest that we had the opportunity to connect with last year at 3686 down in Nashville. Great conference. I'm looking
Yep,
forward
coming up
to
again.
being back there. Yeah, this year. I think it's September 9th to the 11th. I plan to be in attendance at least a day and a half like last year again. So I think it's something that we're
It's
going to
my
plan
birthday
for.
weekend, so I feel like we'll have all the festivities going that week. So I probably have to add that to the festivities.
I mean, your birthday weekend, my wedding anniversary always falls that weekend. So September 9th is the wedding anniversary. So I definitely have to
Yep,
be here for that before I head to Nashville. But, yeah, it's always an exciting, adventurous weekend.
facts. And other good news, I'm finally back able to stand up on my foot, bro.
Coming back, he's about Achilles
Yeah,
healing up, getting back there, getting out there again. So we'll,
yeah.
as you continue to heal up, we'll make sure we'll get you on the golf course and get you watching
Right.
another
And
sports.
off the basketball court.
Yeah, so today let's get into the conversation. We got a partner from a VC firm and want to talk more of capital strategies and particularly opportunities in our geography in this area. So with that, I'll kick it to you, um, Rick, to introduce our great guest today.
Got it. Yep. As Chris said, welcome to another episode of the Always Networking Podcast. I'm your co-host Rick, and today our special guest is Vincent Shea, partner at Cypress Growth Capital. Vincent has a wealth of experience in tech and finance. Having been an entrepreneur and operator before transitioning to the investment side, we're going to have a great conversation about the intricacies of royalty-based financing and how it's a game changer for growth stage companies. Welcome to the stage, Vincent.
Thanks, Rick. Thanks, Fred. Glad to be here.
Man, it's great to have you today. Excited for the conversation. I know we got the opportunity to meet one another at a LPGP breakfast in Nashville. Good friend of ours, Sean Park, made the introduction, so it was a pleasure to connect with you. And since then, you and I have had a couple conversations virtually and through email. And I was particularly drawn to the opportunity to to talk to you because you did a deal here in Louisville, but we'll talk about that later on. But before we get into the conversation, for those who have not met you, can you give us a overview and highlight of your background?
Yeah, definitely love to do that. So I'm Vince Shea, as Rick mentioned, one of the investment partners here at Cypress Growth Capital, based here in Dallas, Texas. Originally from California, born and raised, a huge Laker fan and Dodger fan, being in Southern California, growing up in the era with Magic Johnson and the Dodgers in the 80s with Kirk Gibson and everything. Spent the first 8 years of my career in management consulting, working with private equity distressed assets to turn them around, working on like marketing and operations and finance. Did that for about 8 years, then transitioned to a career in as an entrepreneur operator. Spent 16 years with two different industrial IoT SaaS startups, both of which we exited to private equity. One was kind of RFID and software into construction. The other one was GPS and software, initially into oil and gas, but eventually into other industrial sectors like mining, construction, things like that as well. Like I mentioned earlier, both we eventually exited private equity. Being kind of an entrepreneur type background, working for private equity isn't necessarily the best place to be when you're trying to optimize things or trying to build things. So after doing that for about 16 years, left the entrepreneurship world and became an investor at Cypress Growth Capital just under 2 years ago. I do have a long-standing relationship with Cypress, though. They were actually the first institutional investor in my second company in Geoforce.
Uh,
So they invested about 12 years ago now, helped us grow quite a bit when they invested were about 5 or 6 million in revenue. And we, grew that quite a bit in the time we were with Cypress. So I'd already known the team here pretty well, just as a portfolio company. Later became a limited partner in the Cypress funds as well. And now, as of about 2 years ago, a general partner here as well. That's kind of come full circle with them.
Oh man, I can't help to think about like a restaurant boss when you tell me, you're working as a consultant helping distressed businesses. So can you kind of dive into that a little bit and talk a little bit about your experience as in management consulting, helping distressed businesses, and how that kind of experience led to you getting into entrepreneurship?
Yeah, so one thing I'll say is that there's actually a lot of similarities between restructuring and building. In both cases, you're working with limited resources, time constraints. You got to make something out of nothing, whether that be nothing, be you're a big company that's running out of money, or you're a small company with no money. So a lot of similar skill sets there in terms of dealing with stress, dealing with cash crunches, dealing with irate customers in some cases, depending on the situation. The companies that I were with was Arthur Andersen's restructuring practice before the Enron situation in 2002, and then Alvarez and Marsal after the Enron situation. In both cases, you mentioned restaurant boss. The two primary clientele I worked with were retail, like Eddie Bauer, Spiegel Catalog, things like that, and restaurant chains. Underperforming restaurants.
Right on.
But it's a fun environment because you're mixing a lot of skill sets. You have to understand, obviously, the financial side, cash management, options for raising money, things like that, or options for converting debt into equity, things like that. Also, the operational side, marketing, customer sentiment, demographic analysis, things like that drive the decisions that are being made. And I think for me, this was early in my career, in my 20s. At that age, getting such exposure to CEOs and leadership and board meetings and things like that was a great learning experience. I think that it helped me in the rest of my career. It informed how I became an entrepreneur, informed how I grew my two businesses with our teams, and obviously informs me as an investor, having a broad set of skill sets to be able to look at and analyze companies. So I think it's a great way to start a career is something in the consulting realm where you have let's call it, especially if you want to become an entrepreneur later. I think starting a larger enterprise where they have more formal training programs, a more formal way of thinking about things, analyzing things, presenting things, dissecting things, I think sets you up for a great foundation for doing things in the future. So I couldn't speak more highly of that as a career. Andersen, both Arthur Andersen and Alvarez Marsal had great mentors, great training programs that helped me set things up for me.
And like for early stage startups, like I didn't think I was like a salesman, early on. But then when I realized that sales, it's engineering, you have to engineer that sale. That's when I really kind of fell in love with, that side of sales and things like that. So like learning that structure, that there is a formula to making that, building that business, that really kind of changed my mindset towards, sales.
Yeah, I think sales, so I went to undergrad, but also went to business school. And in business school, they teach you a lot of things like operations and marketing and finance, like the technical skill sets. I think the two most important things in anything you do, and especially if you're going to be in management or entrepreneurship, the two most important skills that you need, sales and people management, or sales and HR, are the two things that don't really teach you in business school. And it's because they think it's an art, not a science. But to your point, there really is at a large enough scale, there's completely a science to sales as well. Like there's numbers driven, it's metrics, it's like the number of at-bats you get that turn into this batting average, get you this yield, et cetera. That's very scientific and very process and very sales opsy, So I think that's what my biggest regret is. They don't teach you that in business school. You learn it on the job, so to speak, both managing people, the HR side, and how to run a business. Sales is the most important thing for a startup or entrepreneur. If you can't generate revenue, it doesn't matter what kind of product you have or what kind of people you have or anything. So
right.
It's so important. You make a great point there, and really taking those skill sets and transforming it into something else. So what was that tipping point from management consultant into entrepreneurship, and what kind of gave you the itch to get into it?
So I would say that I've always wanted to do it. But to my earlier point, my dad was an investment banker, and he said, don't do banking, do consulting. Because a little more financy, more transaction, and consulting is a little bit broader. And to my earlier point, more, analyzing things from many different angles beyond just finances, let's call it. So I did that first as a starting point. He said, even if you want to be an entrepreneur, go get the basic skill set, all that, the learning, everything. I mentioned earlier, business school. I was in the first year of an executive MBA program that my boss was paying for. And 1 year into it, met one of my colleagues in business school, and we got the itch 1 year in to a 2-year program to start a business on a whim. We were actually on a class trip in Korea and at a Canadian bar because one of our Canadian classmates was homesick. So we're at a Canadian bar in Korea at 3 a.m. And drew up the business plan kind of literally on a napkin kind of for Atlas RFID solutions. And then later, like maybe 4 a.m., we're sitting on the curb in Korea eating like chicken for 25 cents, I think it was. Chicken on a stick with like 2 or 3 of us talking about how we should just go do it. We're going to quit our jobs tomorrow. Obviously, a little bit probably not fully functioning in mental state at 4 a.m. And did. And then 2 days later, we both kind of quit our jobs. And, even though our bosses were paying for business school at the time, paid for business school our second year ourselves while we're starting and launching Atlas. It actually became kind of the class project. So a lot of our initial friends and family investors were literally our own classmates from business school in the executive program. It was almost like the class project. Like everyone wants to see what Rob and Vincent are doing, contribute to it, like they're 10 grand or 25 grand or 100 grand, whatever, to help us see it through as a success, just because it's almost like, again, like a class project, almost like the class guinea pig, but now we're like the, business, right?
You're building in public right there with your classmates. So that's, that's cool.
A good vote of confidence from them. So that initial spark came from that. Consulting gave the foundation, spark to do that. Honestly, we didn't really know what we were doing. Neither of us had any RFID experience. Neither of us had any entrepreneurship experience yet at the time, obviously. But we just said that RFID is going to change the world, because this is back in 2005 when Walmart, DOD are all talking about RFID mandates. And we had a professor in operations talk about how RFID is going to change the world. So we said, we're going to start an RFID business with no RFID experience. And we hired engineers and all that. And we got off the ground and we did fine. In fact, in our first year, we landed 15 projects with Honda, Hyundai, London City Airport, Sealed Air, to do projects, projects with services and hardware, let's call it, and some software programming, which sounds great. It all sounds great. The problem is that we didn't know this, but they were basically just science projects for them. And the problem with the $1 million statement of work is that the $1 million ends after 9 months and you have no more revenue. Right. And so you can see where I'm going with this. And there was the recession in 07, 08, a bunch of our projects got canceled. And the company eventually pivoted to becoming more of a SaaS offering, like taking some of the software and stuff we had built for some construction companies and turning it into a product and SaaSifying it, if you will, which is whatever that verb is. That's the kind of pivot the company made over time that was necessary. But the next company, Geoforce, started out as a SaaS platform from day one. So it didn't have that issue, but some of that was the learnings from Atlas, but that was a big transition for us. Eventually sold to private equity, and eventually sold to strategic as well at Atlas. But definitely some learnings along the way.
And Vince, what year is that? So that trend, selling to private equity, what year was that? And when you made that happen? So
early 2010s, I want to say. Yeah. And then Geoforce, we sold to private equity in 2019, right before COVID.
Okay. Okay. I just asked that because I feel like we're at this time now where we're seeing more startups going back to that private equity playbook. And you can correct me if I'm wrong, but I'm seeing more of that happening. And I think it kind of leads into where you are today. I'm kind of just curious, are you seeing those same kind of exits now for startups and more private equity driven compared to,
compared in the old days, if you were successful, you went public, but public is too expensive, too complex. It's a boys club or whatever club you want to call it now. It's a very different world. Private markets definitely uptick for everything you just talked about. It's just a smart way. There's plenty of private money now to be had where maybe there wasn't before. So it's definitely a very viable opportunity that a lot of people actually prefer it, honestly. There's a natural evolution for companies. I sort of hinted at some of this with my background, and both my companies kind of went through this process. There's sort of from left to right, you could have the least amount of capital, but the most control. And then on the other side, you have most capital, but least control, right? It starts with your own pocketbook, basically literally self-funded or bootstrap, literally your own checkbook, your own credit card, your own home equity line of credit. You have 100% control, but usually that resource is limited, unless you're wealthy already, right? So you start there. The next way to raise money is, I think, friends and family, which is basically an extension of your own pocket. You already know these people. They're mostly investing in you, not necessarily the idea or the company, because they just know you. They trust you. They worked with you. They've known you, their friend, family, whatever. That's like an extension of your own pocket. And then from there, there's sort of angels. Angels are like friends and family that you didn't know yet. They're strangers who become friends and family, hopefully. They're a person, not a company. They're a person, not a firm. And they're investing out of their own pocketbook, but they're not quite a friend, but they're sort of extension of a friend, angel. And then you kind of progress to more institutional, like a seed fund, There's several of those in like the Commonwealth Seed Fund in Kentucky, for instance, like a seed fund, which is bigger than Angel, but also not a person. It's an entity or a firm or institution, and they can write a slightly bigger check and get you going, get you more publicity than like an angel will get you necessarily, because it's an official thing. And then you go from that, you can maybe progress to like venture capital in different stages, like Series A, Series B, Series C, but tends to be more minority investments when they own less of your company along the control spectrum. And then from that, you can get into like private equity, which you asked about, which tends to be more majority or control stakes, where they buy more than half the company, they take over the board, they run playbooks, they dictate things more, which is my earlier comment at the beginning of this conversation, where being an entrepreneur working for private equity kind of sucks. Because you wanted to go build something and it's already built now, and they're going to help optimize and grow. And there's people who are way better at running it at that stage when they're bigger than maybe I did. Like the best analogy I have, I have 3 teenagers now, and I used to coach them in soccer when they're 5 years old, 7. I coached them in basketball when they're 5 years old, 7 years old. When they got to 10, 15 years old, they need a different coach. They need a real coach, not me as their coach. The same thing with the company. Like the company grows up, they need professional coaches, not someone who's not, right? And so I think those are different stages you can go through, from left to right, from bootstrap all the way to private equity, to eventually you sell the company to strategic and they own 100% of the company. You sell to IBM or whatever, like along the whole spectrum. And most people go maybe skip a few steps, but you're usually along that journey. And primarily I think I found for myself was that once we got to the private equity stage, my skill set was better suited to the like 0 to 25 million or 0 to 40 million revenue range, not the like 30 to 100 million range, which is people who are optimized for doing that. And so what I like about working with Cypress portfolio companies is our companies are generally between like 3 to 20 million in revenue when we invest, maybe 5 to 10 is the average. And so it looks like I just lost the camera. Sorry. Yeah, so what I like about with Cypress is that we're working with companies that are generally between like 3 million to 20 million revenue when we first invest. Probably the average is mostly 5 to 10 or 5 to 12 million dollar type companies. So to my earlier soccer and basketball coaching analogy, we're working with companies when they're like 5, 7 years old, when we can be really impactful and help them, not when they're teenagers or older, where maybe private equity is better suited. They need more playbooks and things like that. At this stage of companies, they're all over the place in a lot of things and different functions, different things they're doing. And we're able to kind of help, be a sounding board and advisory board to them to help them think through things like go-to-market, pricing, product strategy, even the people strategy of like the types of people you need when you're smaller versus the types of people you need when you're bigger, and how to evolve a company. So we spent a lot of time working with our portfolio companies as former entrepreneurs and operators. We have insights and guidance from our experiences. We help to guide them on how to make that journey through the different stages we talked about.
I love that. And as you bring up Cypress Growth Capital, where you're at today, you joined as a partner later on. So can you maybe give us the origin story of how Cypress Growth Capital started and kind of how it's evolved over the years?
Yeah, so our 2 co-founders, Bart Goodwin and Ed Mello, they both had decades-long experience as operators, running sales, running North America, running different teams for big consulting firms, but also having worked at some startups. One that went public and so did successfully, and one that didn't do that well. So kind of saw both sides of it. So I had big company operating experience, like I mentioned, my consulting background, kind of that big company type experience, but also the smaller experience. They were later in their careers and decided they wanted to transition to doing consulting work, and then eventually from that, as part of the consulting work, working with high growth startups, came across this idea called royalty-based financing from honestly a Facebook post they saw. In 2009, 2010 timeframe, reached out to the guy who did the post and found out about this model for royalty-based investing and decided to go license that and use it at a larger scale to invest in software and tech companies across the United States. The guy was talking about doing like royalty deals for like 25 grand, 50 grand, kind of like what Mr. Wonderful does on Shark Tank. But Ed and Bart were talking about doing this at the multi-million dollar stage in multi-million dollar companies. So much larger scale. More to your point, Rick, earlier about more process and formulaic, but more formulaic than thinking through how you assess companies and applying the royalty model to high growth software and tech enabled services companies. So they launched the company in 2010, the firm in 2010. My company Geoforce is actually one of their first investments, like their 4th investment back in Fund 1, and now we're starting to deploy Fund 5, 14, 15 years downstream. So they start with this idea that there's like this funding gap for companies that need like $1 to $5 million at that like $5 to $10 million revenue range. There's sources and options for getting money at the seed stage, angel stage, friends and family that we talked about earlier. There's definitely sources for like growth equity and private equity later when you're bigger. But when you're that kind of that tweener stage, I was calling like a 5 to 10-year-old kid, like tweener stage of a company where you're not quite big enough to need to raise $10 or $20 million yet, but you also need more than 250 grand from a seed investor. You need 1 to 5 million to kind of go like jumpstart things on sales and marketing, go hire a real VP of sales, go build out a product team, go hire a marketing team or build a marketing team, especially in these like more bootstrapped, underserved markets, which is where Cypress invests. We're not investing in Silicon Valley, New York, Boston, Massachusetts, New York, like that. We're investing in Louisville, Nashville, Atlanta, Kansas City, Pittsburgh, Charlotte. These are all places we've done deals recently. Denver, places where like people can stretch a dollar faster, which is what we love about Kentucky and Louisville. Like we'll talk about handle later, but things like that. And so we thought that they thought there was a market there that needed that capital, but also because at that 5 to 10-year-old kid stage, need not just the capital, but also the advice and the counsel for former entrepreneurs. So everyone on our team is a former entrepreneur, former operator. So we can help advise them on things as much or as little as they want. And so that was kind of the model going forward, was that we have this team of people who can advise you, like hands-on experience and mentor you or whatever, the right amount of capital for your size of business, not too much, not too little. And also it's a non-dilutive royalty-based product. So the way it works is, in general, you're paying us back a monthly royalty. That's a percentage of the cash you collect from customers every month, not necessarily revenue, but the cash you actually collect. So which can sometimes spike, sometimes peak, right? Peak and valleys of cash collections. So you pay us a royalty every month that's tied to your cash collections. You keep paying back that royalty every month until in aggregate you pay off a predetermined, multiple of the invested amount that starts at 1.5 and generally scales to 2x the amount you took. So if you took like $2 million, you might pay us back $4 million over time. But the over time is as long as it takes you to pay it back based on how fast you grow. So it's very flexible. It's not fixed payments. There's no fixed end date. Where like you have to pay us back in 3 years. It takes you 10, 15 years if it has to, or 5, 10 years, however long it takes. And unlike equity, it's capped. It can cost you, let's say, 2x in a few years. Whereas equity, if you're growing nicely, the equity might cost you 5 to 10x for that same couple $1 million. That's lots of money at stake that can change hands, right? And so you kind of have a capped upside versus equity. You also have, like, compared to, let's say, traditional debt, if you could get it, no personal guarantees, no covenants, no fixed payment, no fixed end date. So it's very kind of a hybrid solution. It's like there's a lot of optionality and flexibility to entrepreneurs to dictate when they want to have another transaction or an exit, if at all, and how fast they want to pay us back, but at a capped return or capped cost compared to equity, which is uncapped. The last thing I would say about this point is that, it's meant to be something that's really for someone who's really bullish about their company. They think that equity is going to 5 to 10x, so this seems cheap. This seems cost effective for them. If they're not that bullish and they think they're only going to 2x their business, then maybe they don't want to do this, and they kind of self-suck themselves out, But that's generally what we're doing here. We're like an alternative to debt and equity that kind of sits in the middle that gives people an option to like fund growth, a few $1 million of growth capital at the right time for them that bridges them to an eventual transaction. Like 90+% of our companies, within about 4 years of taking our money, they exit us because they go do a growth equity transaction, a private equity recap like Geoforce did, or they sell the company outright. Like 2 of our companies just sold to the IBM and Five9 fairly recently, as an example. So that happens. So they usually were a bridge to that. And when we bridge that transaction, we do that transaction in a few years, you're doing a much higher valuation, better terms and everything.
Wow, man. I mean, I see so many benefits, of this product, coming out of, 2020 and how financing and investment has been, post pandemic. I see, thinking about like trying to get loans. I see this is a loan for almost the unloanable businesses that are kind of, like you said, right there in that between that rock and a hard place. When you talk about that royalty-based financing, but it's a lot better than a loan because, like you said, there's no payback terms. Their interest is capped, like you said. So could you talk a little bit about some of the success stories where this unique funding strategy has made a big difference for companies?
So I'll just add one more thing to your comment about the loan structure. So usually companies of this scale, they at best get like a 250 grand or 500 grand loan, and it's probably personally guaranteed by their house. And it fixed payment, covenants, all that stuff. We're not only everything you just said, but plus it's usually a larger size. Like we're investing 1 to 5 million, not 250 grand. So, but we're taking this risk because we get to know the entrepreneurs really well. And since we're former entrepreneurs, we can see through the bullshit faster, I think. Understand a real viable business and a real viable entrepreneur. So we can extend more than the bank might do. We're more like equity investors. Like we behave more like equity investors, but our equity is capped in this case. It's capped at like, a certain multiple versus like 10x or uncapped. You know what I mean? And that's kind of why it's attractive to certain entrepreneurs. In terms of success stories, I mean, there's a lot of them. We've had 56, soon to be 57 investments we made across 14 years. 34 or so of them have exited. The other 20 something are fairly recent investments that haven't exited yet, but will at some point, obviously. Those 34 or so exits, to my earlier point, all exited one of three ways. Basically, they did a growth equity transaction where they raised, $10 million, $20 million later, like my company did, from at much better terms, and they delayed it by a couple of years, so they got better terms. Like you mentioned the funding gap. Right now, the funding market now is sort of bad. That's kind of why we've been really busy. We've done like 11 deals in 16 months, the last 16 months, because so many people are using us as a bridge to go do an equity round maybe 2-3 years from now, like delay the equity by a little bit. So a lot of them do that. A lot of them go and sell to a private equity firm. We've got a few doing that right now. And then a few of them go and sell directly. They skipped all those steps and go straight to sale to a strategic. Right? All those have happened, and we help them with that, with capital strategy and planning, introductions to bankers, acquirers, things like that on a constant basis. Some notable success stories, my company, Geoforce, we raised money in 2012. We eventually did a growth equity round in 2014. We eventually exited to LLR Partners in Philadelphia, a 9-figure exit, all enabled by Cypress's advice and counsel, but also the non-dilutive product helped us preserve our equity and board control for a lot longer than we would have if we not raised money from Cypress.
Okay.
Another company called Dialexa here in Dallas, by the name Scott Harper. They raised money from us, 5-8 years ago. Grew quite a bit. They were in our offices working with Bart and Ed and some early people at Cypress almost on a weekly basis at the beginning because he was a first-time entrepreneur. He would come to our office with like a notebook with questions and thoughts, and they would sit in the office on the whiteboard and spend an hour or two every week just talking through everything, like how to compensate salespeople, how to hire and retain a really good sales team, pricing strategy, marketing thoughts, things like that. They would go through all that. And then after maybe 6 months, he didn't need a little bit less of that. The training wheels started coming off a little bit. He ultimately grew the business and sold to IBM a year or two ago for a very large sum that's publicly disclosed in some places. Again, all enabled by our non-dilutive growth capital, allowed to preserve equity for a long time. There's another company called PFA Solutions in Virginia, run by a person named Richard Change, who ex-Carlyle Group, spun out maybe 5-10 years ago to start this thing. As a PFA stands for, I think, Private Fund Administration, to help investors manage their carried interest and compensation, things like that on a software platform. That's been highly successful with our money and grown quite a bit with our capital. We've had companies that exited us, and then the entrepreneurs, myself included, then became investors in our fund because they were successful. Yep. They paid it back, so to speak, and invested into Cypress's funds as well. So tons of success stories. Many of them are on our website. Actually, we got videos, we've got stories on all of them. So all of our investments are publicly disclosed on our website with the information. So
I love that, Vince. And I one thing I want to tap into, because we've been talking about the royalty-based financing side of it, but you also do equity investments as well, or a combination of the both, right? And so particularly, this is before the official announcement, but when you and I met and you find out I was came from Louisville, we mentioned Hando, and maybe that's a great use case to talk through the balance of the royalty-based side of things and the equity side of things, and how you all think as a firm, as like you said, you're still equity investors with this other product to help find the best opportunity for the entrepreneur, but you still want part of the upside as well. So can you talk through what Hando, what drew you to that company, and why you're so kind of bullish on the Midwest, middle of the country for some of these type of investments?
Yeah. So to the equity question. So yeah, we lead with royalty. Look at our website. We mostly talk about royalty, but it also mentioned on our website companion equity. So we do equity investments, but currently only as a companion to the royalty investment. So like in Handel's case, we'll talk about later, it's like half royalty, half equity. We led a Series A as well. or a follow-on at a large scale. Like we invest in the royalty thing, it worked, they grew, they want follow-on equity to like $10 million or north, we could help do that as well, right? But not as a standalone product. We do equity as companion or follow-on to the royalty. In some ways, the royalty is like our farm system to feed the big league team, if you will, or it's like a pilot project. I don't want to use that term too loosely, but like we try at a lower scale. We get to know each other before we make a big commitment. It's also good for the entrepreneur to get to know who they're working with. You get to actually work with us, not just court us or be courted for a few months. Actually work together for a few years before you commit to a larger equity transaction on both sides. So that's kind of the equity side of the story for Cypress. Currently, that's our structure, is companion or follow-on equity. In terms of Handle, so Handle came to us through another investor that talked to them that was a much larger equity fund that wanted, to my earlier point, wanted to invest more than 10 million. Handle did not want that much yet. They might eventually need that, but they didn't need that yet. So they referred us to, we have a good working relation with that equity firm. We got to know Kyle Green and his leadership team pretty well through the course of, like, he came to Dallas, we were in Louisville, obviously some Zoom meetings and things like that. And if you guys know him, he's salt of the earth, down to earth guy from, I believe he didn't play college basketball in Kentucky somewhere. Just a humble guy. And this actually kind of helps answer your question about the Midwest and why we like to invest outside the coast. We just like working with salt of the earth people who get their hands dirty, who have the bootstrap mentality, which Kyle has, of being resourceful, stretching a dollar, but not being penny wise, pound foolish either, by making the right investments in the company, but they're making strategic investments that make an impactful change in the company's trajectory. Not just like, let's have Bono be at our Christmas party because we think it sounds cool in Silicon Valley, things like that. So what drew us to Handle was that Kyle was great. It always starts for us. The diligence process starts with understanding the leadership and the CEO, because since you guys are in Louisville, use a Kentucky Derby analogy, it's the jockey, not the horse, that matters at this stage. Way more, right? At the early stage, the jockey matters so much more, right? So we really spent 80% of our sessions really getting to know the leadership team. Do they have the mindset, the skill set, the resourcefulness, resilience to be an entrepreneur and grow a business? To my earlier point, we're all former entrepreneurs. We can think that way and think through it and see it. If that's a no, then we don't even worry about anything else. Like, we got to make sure that the leadership team is there, that he or she can attract and retain good talent around him. If we meet with a company and that person does all the talking and the rest of his team doesn't talk, then we won't invest. That either means that he doesn't trust the rest of his team, or the rest of his team is incompetent, right? He's hiring a bunch of yes men or whatever, right? We want to make sure that he or she can surround himself with good talent, because even though I said as a jockey and the horse, you're going to need a lot of jockeys to grow a business, a leadership team. So we first and foremost assess that, and we really like that about Kyle and his team that he surrounded himself with. Then we look at like kind of the product, the market, all that kind of general stuff. And then the last thing we might look at is financials, because if you're good at all those other things, people, product, market, the financials will follow, especially at this early stage. The financials don't say too much yet anyway. A lot of times not even clean or anything, right? We looked at the product and the market, and what we really liked about Handle was that they start out as like a marketplace for healthcare assets and a services business, let's call it. But all the data and the relationship they developed through being a marketplace and a services business enable them to go build a great product, a great software product, a SaaS product, let's call it, a CCM, capital cycle management, I think it's called. And what we're investing in and what they wanted our growth capital for was exactly what we like our money to be used for. Is they know how to get there, how to grow this business on the SaaS side while they continue to maintain, obviously, the marketplace and services. They just need capital to go develop the software and hire the right sales team and marketing team that's unique or different from this team that might sell marketplaces, right? To be able to build that out. And we just had a lot of conviction that given their track record on the other side of the business, the marketplace and services, they would find success on the software side as long as they have the right capital and some guidance from us of how to scale a SaaS business. So that's really what we liked about them. Will we have invested if there's going to be a marketplace that kept growing as a marketplace? Maybe, probably less so than the fact that they're going to go invest in the software side and build out a SaaS product, which is what they're growing on right now. So that's what we really liked about what they were doing there. Your other question was about kind of the more general Midwest. So our investments are all in the Southeast, Southwest, and Midwest. One of our partners is from Ohio, so he covers the Midwest mostly for us, Pat McCaffrey. Okay. I kind of cover the Southeast since my stars were down here. And we have another person that sort of covers the Southwest in general, but we're a small team, so we all kind of cover everything. We have a new partner that joined that has a healthcare background who sold a healthcare company a few years ago. So as you have healthcare deals, whether they're in Nashville or wherever they might be, he's probably going to get more engaged, right? My background's in industrial tech. Both when it comes to industrial tech, manufacturing, oil and gas, things like that. And so it's natural, like Louisville or Kentucky, in general, a lot of manufacturing, a lot of industrial tech, a lot of like more of the hard assets and, devices and hardware, all that kind of stuff makes sense for me to plug in as well, So that's kind of what draws us to Kentucky is that. I think we saw that like CNBC said that Louisville was Kentucky was rated number one place to do business by CNBC last year. So obviously we're talking about startups. We want them to have a place where doing business is easy, not hard. So that's all the things that attract us to Kentucky in particular.
Oh man, that's awesome. And see Handles, continued growth with you all, working with them. It's been great to see. One of the things I want to, discuss now, we talked about all of the successes. What are some of the challenges, that you all, face with startups? So if there's no, terms on this, on the revenue, royalty-based, I know there's no time limit, I guess is more so what I'm trying to get to say. Like, how do you all manage, that from working with companies from that perspective? If a company is, I don't know if they're missing payments or if, the average payments aren't kind of working out to 10-year return, how does that work?
So then by far the number one factor, and this is a general statement for all venture capital and all private equity, the most important factor in determining success of the investment is the initial selection of the investment. If you pick a dud, it's going to be a dud. If you pick winners primarily, then you're going to be a winner in the long run. So it goes back to my earlier comment, 80% of our assessment, and we spend a lot of time in the initial discovery and diligence phase than most companies will, is really getting to know the entrepreneur and the company. And I'm not saying we're perfect, but to be able to source the good and the bad, right? The filter out the bad from the good on the people side of it, right? So we pick good entrepreneurs who are going to make good decisions and who are coachable, meaning that they're not so like, they're just going to go do the thing and they have problems, they never come talk to us. If there's problems, we want to talk to them about it. And we build enough of a relationship with them. We're on text chains and, Saturday afternoon calls with them sometimes just to talk through things. We're an advisor, we're a friend, we're an investor, we're a colleague, we're a peer, however you want to look at it. They feel like they can lean on us to talk about the good and the bad. And any startup's going to have good and bad. There's no bullshit about it. Like, you're going to have ups and downs, but net trajectory is up, So we build that open relationship with them. So our number one underwriting thing is that we find good people and we spend a lot of time talking to lots of companies to find like a few good ones a year, right? So very high bar for picking what we have. And then once they get in, they have to make this monthly payment. That sort of controls itself. In 14 years, we've never had a company miss a monthly payment. Sometimes the monthly payment's lower. Sometimes they ask if we can defer by a month and we'll let them do it, but at least they deferred it. It's like it's accounted for and everything. But they never missed it because they tend to be growing. Even like someone growing slowly is still growing. Our companies grow slowly, they grow nicely, but they're all growing. So they always make that payment. And we can't dictate when they exit. They could keep paying us stuff, quote unquote, forever. But almost every single one of them, because of our counsel, because of our capital, but mostly because of their own hard work and their own, work ethic, everything they're doing in their business, everything being good entrepreneurs, all of them grow. And because all of them grow, all of them find success because they're attractive to equity, they're attractive to a buyer, all that. And so it's not like I'm not saying it's easy, but they certainly have people knocking on the door pretty quickly, within a year, 2 years, 3 years of us investing, saying, hey, I saw that Cypress invested when you were 7 million revenue, and now they're like 20 million in revenue. Would you entertain this or that, right? And so we're picking good. It's sort of like we're picking an all-star team. So of course our team's gonna be good on the court, Yeah. I know that sounds a little like bragging, but like we don't pick bad companies or bad entrepreneurs, very selective, like, in terms of who we pick. And that's why almost nobody actually goes on paying forever. Like 1 or 2 of them have gone off like 10 years or 8 to 10 years and they paid us off. The vast majority are exiting. I think the stat is that 77% exit in 4 years. And the other 23% maybe in the 4 to 8 year mark, let's call it. The vast majority are exiting, 3/4 or so are exiting within the first few years.
Yeah, man, and particularly you talking about on the venture side, you've seen, like you said, companies are running longer. They're not as many going public. So you're talking about getting a liquidation for your LPs. Your exit strategy looks much different. It's really around, like you said, the equity investment or a sale to a private equity company or anything in between. That kind of gives you a better playground for you guys to move quickly, invest more capital as well. So I love that part of
Yeah.
on
And it's the
entrepreneur.
entrepreneur's choice. We cannot dictate
Yeah.
how or when they exit. They dictate how and when. And the how is
Yes.
equity, sell the company, or just organically
Yep.
pay us off in 8 years. However long it takes you to grow there. You can
100%.
pay us off. You can never have another transaction. And it's
Yep.
organically hit the cap and you're done. You pay the monthly royalty, you hit the
Yep.
cap, you're done. That's happened honestly
Yep.
once ever. The other 30 something
Yeah.
exits all one the other ways I was talking about.
Yeah, I can see how you're on Fund 5 now, because that time is compressed. Getting more capital back to your LPs quicker as well. But if you're an early stage founder and you're talking about, or a founder in general, and you're talking about picking all-star teams, at what stage or revenue should a company start engaging with you to start building a relationship if they're interested in this product?
So our investment mandate is 3 million to 20 million in revenue. Because of our capped upside or capped costs, we can't take unnecessary risk investing in companies like $500,000 in revenue or $1 million in revenue yet. By the time they've gotten to like 3 million plus, they kind of have good product market fit. They're the beginning of a sales team. They have real customers that are paying them. They have some semblance of like a marketing and sales. Like there's again, to my earlier analogy, like a 5-year-old kid. They can walk on their own. They're not on diapers anymore. They can do things, but they're not like fully formed yet, right? So we like them at that stage. And so because our lower threshold is 3 million with a company with strong conviction in, we start talking to companies around 1 or 2 million in revenue even just to build the relationship. So even if you're under 3, but you feel conviction that you're going to get to 3 pretty quickly or in time, we love to start the conversation now. As you guys know, a lot of our best investments are ones we spent 2-3 years talking to, from when they were undersized to when they grew into our size, or when they were smaller and they grew bigger. And so we build relationships, we maintain them. We take market trips to cities and meet with entrepreneurs all the time. I'm going to Nashville in 2 weeks, for instance, to meet entrepreneurs and stuff. So we like to talk to them early, and even if they're like pre-seed, we like to talk to them just to build a relationship and mentor them and give them thoughts and ideas on where to go, so that down the road, whether it be royalty investment or to our earlier point, equity investments, we can maybe support them then, or not, just to be helpful is good too.
Man, it sounds awesome. We talked about, I want to just for our Louisville audience, I want to kind of tap in and say, just ask you, what potential do you see, in the Louisville startup ecosystem after the investment, and handle? I know we're a very healthcare centric space. So are there specific sectors or types of companies in Louisville that you find particularly interesting?
So healthcare for sure. That's why we're going to Nashville a lot. I think something like, if you look at our website, maybe 5 of our last 9 deals or something like that have been healthcare things. Right, Handle, obviously, we did a PEG 360 in South Carolina a couple of weeks ago. That's patient engagement software for like clinics and things like that. We've done several healthcare. We did a Thorough Care in Pittsburgh, critical care type stuff, 2 or 3 years ago. And we just hired a partner, Cliff Centel, who started and built and exited a healthcare company here in Dallas, and joined us about 2 months ago or so as a partner. He's going to help with everything, obviously, but his background's in healthcare, so he'll help a lot more on the healthcare deal. So very keen on that. That said, we're not just like an industry-specific type investor. We're investing in legal tech, cybersecurity, restaurant tech, with the company in Atlanta we just invested in called Franklin Junction. So we're investing across the spectrum. We're picking good entrepreneurs who are subject matter experts, and we're supporting them with things outside their subject matter expertise, potentially, like capital strategy or go-to-market strategy or whatever. But they're the subject matter expert on the topic. So healthcare is a big one, and that's why we like Louisville. I mentioned earlier my industrial manufacturing tech background with RFID and GPS and everything. So anything in the industrial side or manufacturing we like, which is why we like Kentucky. There's a lot of that as well. Hardware is hard, we call it. Like you have to incorporate it in software, but it also creates a moat. Having a hardware centric part of your business that drives software revenue in this case, right? And so we like that as well because it's hard, but that also creates this differentiator and moat for people as a company. And we kind of uniquely understand that, given my background. One of our other partners came from an industrial tech background again, as well as vehicle tracking and things like that. So we bring that to the table. We just did 2 industrial tech investments, one in the camera sensing space in Colorado, and then one that we're about to invest in that does drone detection here in Dallas, for instance. So those types of things are things that we'd like to do as well. I think in Louisville, we looked at like Fresh Fry, was it? That's in the restaurant tech space as well. Kind of similar to
Jeremiah Chapman.
Yeah, not just. I talked to him, I think, 3 or 4 weeks ago. It's not just software, right? There's other components. So we've talked to him. Things like that are interesting to us.
Yeah, Jeremiah's phenomenal. It gets me thinking. I know you introduced me to Pat via email, so we have to get you or Pat here for an in-person event and meet some more founders here. Hopefully, we'll have some dinners coming up this fall. But as we get ready to close out, I know you mentioned you're going to be going to Fund 5. How big is Fund 5? How many deals you anticipate doing with this next fund?
Yeah, so it's funny you say that. Our email announcement just went out this morning, and there was a story in Dallas Innovates last week that I'll forward to you guys after this call. Okay. So Fund 5 ended up being 60 million, 60. So we're oversubscribed by 20%. It was supposed to be a 50 and became a $60 million fund, and we closed it in 43 days from in early March to April. Mostly a lot of our Fund 3, Fund 4 investors re-upping, and then also new people coming in to get you that 20% extra. And it's a mix of high net worth individuals, including a lot of our former portfolio company executives who sold their companies and then invested in our fund. Maybe let's call it less than that, a little bit under half of that. And another half or so is family offices. A lot in Texas, obviously, but also around the country. A lot of family offices as well. So $60 million fund for this royalty-based strategy with some equity components we talked about. Probably invest in something like 18-ish companies, so call it 6 a year for the next 3 years or so. Which is uptick from like the last fund. Fund 4 was 16 companies, 16. So a little bit more because it's a larger fund, but also a little bit more into each company as we get bigger here. We've also hired more people on the team as we have a larger investment base. We have more companies we're supporting, more companies we're looking for. We're also going towards the direction of probably having a larger equity fund as well. The sidecar, not sidecar, but alongside it, that'll be in the 9 figures. That we're in the middle of raising as well right now. That will allow us to make larger equity-only investments into companies. Like as an example, Handle, we're going to grow and eventually want to raise 20 million of equity. We can do that at a separate equity fund, not the existing royalty fund. So that fund will be getting 9 figures, probably a launch later this year, and we'll announce that publicly later. But that's something that will kind of complement our strategy. Instead of getting bigger on the royalty side, we keep doing the royalty thing to feed us. But the equity will be something that gives us a chance to invest in some of our best royalty investments, and also have a chance to invest in good companies that are maybe too big for royalties.
Man, that's exciting. I'm seeing that growth, and I'm just kind of curious from the Fund 1, 2, 3, and 4. Typically, what has the fund performance been that kind of led you to continue to get growth in Fund 5 and oversubscribe?
Yeah, so to your earlier point, like the number one reason why our LPs re-up is that they might really like us. They might, think we're cool to hang out with or whatever, maybe. I don't know, we'll see. But the number one thing is to look at our track record. Like we have 4 funds of actual data. And like I said earlier, we disclose all of our funds all of our investments on our website, and all of our LPs have full access to the performance of every single company we've ever invested in. Every gory detail they ever wanted. And the track record is really good. Mostly because we pick good companies, to my earlier point, and we support them, we help them, they're doing well, but also because of the model itself. The model itself is this royalty-based model where no matter what, starting at month 1, they're paying us something. And so the LP's getting something back. And no matter what, they're paying us like a kind of a guaranteed, somewhere between like 1.5 to a few X what they owed us. We're never going to get a 10X return. We're never going to get a 0X return. On every single deal, we're getting between, call it 1 to 3X. Something somewhere in that range. Average, let's call it a little bit over 2X. And so what we're returning to our LPs is pretty consistent. So pretty high IRR, pretty low standard deviation, all that, and pretty high multiple. Because it's sort of to use a baseball analogy, kind of a guaranteed single and double on every single deal, but no strikeouts and no home runs. The company could be a home run. If Handle's a home run, great. But our royalty investment will pay off as a double or whatever, right? The cap return, right? But we're getting a double or whatever on every deal. And so if you can imagine, or not to disclose private information, but like across 4 funds, very consistent, very narrow range of performance, a very narrow range on everything, which investors like, just the guaranteed, almost guaranteed annuity kind of consistency.
Yeah.
They're getting paid back pretty quickly because an equity fund investor, you wait till like year 5 to year 10 to get paid back. Here you're getting paid back starting year 1.
Yeah, and your variance, has to be crazy low, versus, a standard traditional fund, there, like you said, a very narrow band. And those investors, can see the results of that investment almost immediately versus it's 5 years off. So like, yeah, I mean, it makes way more sense to, re-up more quickly than with a traditional fund.
One guy told me that I'm investing in Fund 5 with the proceeds I already got back from Fund 4. We were paying it back in Fund 4 capital. I mean, also, if you want to talk real numbers, right? Like you look at PitchBook and all the data across the last 15 plus years, we're basically top 5% or top decile for private debt funds in our first few funds. So top 5, top 10 percentile. And then against other equity funds, we're top quartile. So top 25 percentile, but with minimal risk.
Yep.
So we're getting this like, high IRR, high multiple compared to equity funds, top 25%. But a lot of them have much more. They have like a 5% fund and a 50% fund. We have funds that are very consistently performing in a narrow range. So that's why people like us, because we compare favorably to both debt funds and equity funds.
Yeah, I love the strategy. You're talking about getting singles and doubles guaranteed now, and you already have a long-term relationship. So it only makes sense for you now for you to go get a bigger equity vehicle and ride those singles and doubles to multiple home runs as well. Because I think this is a great opportunity for you all. So Vince, great work. I love what you are doing. I love your focus in this area and geography. Hopefully I get to connect with you again in Nashville soon. I know you spend a lot of time down there, and just definitely I really appreciate your time today.
Yeah, I'll be at 3686 on 9/9 and 9/11 as well. So I'll see you then.
Cool. So if you're in Kentucky, you're in the area, tap in with me and Rick. We'll be down there at 3686. I'll make sure to get you connected to events as well, and we really look forward to the opportunity to connect again.
Yeah, I was in Louisville a lot more. My brother lived in Louisville about 10 years. And moved to London, like England, like 2 years ago. So for those 10 years, I visited probably 3 or 4 times in Louisville. Right. All the tourist attractions you mentioned in your building SC blog posts, like the Muhammad Ali, the brown, what is it called? Brown, was it brown chicken? Not brown chicken. Hot brown? Yeah.
Hot brown.
He lived there for 10 years. He had 2 kids there. So they're Kentucky. His 2 sons are Kentuckians, I guess.
Yeah. Kentucky boys.
Yeah.
There you go.
The time today.
Next time, we'll get you back here soon, and until next time.
Yeah.
All right. Thanks, Vince.
Thanks, Rick. See you soon.